Revenue fell 5.5%. Distributions shrank by 6.1%. For a retiree holding Mapletree Industrial Trust in their supplemental retirement scheme, that is a direct structural reduction in your monthly passive income, and you simply cannot ignore it. I had to run these gearing numbers twice. What looks like a digital sanctuary on the surface has very deep cracks in the foundation once you dig into the pro forma reality. The question we lead with today: is this 6.33% yield a sanctuary for your capital, or a yield trap in the making? I want to be straight with you before we get into the data. I tracked this one personally. The Singapore franchise is genuinely strong, but the numbers I found in the footnotes almost completely flip the narrative that management presented in the highlights. And that is exactly the kind of gap that costs heartland investors real money if they miss it. So let us work through this together. The numbers tell a story that the glossy earnings highlights often try to soften. Revenue and distributions have taken a visible hit, but the institutional desks barely blinked on earnings day. This creates a dangerous gap between what the market expects and what a retail investor actually experiences in their wallet. The headlines might say stability. The data points to a portfolio that is starting to feel the weight of its overseas expansion. We are stripping away that management noise today to find the true organic flaw of this data center giant. The distribution per unit dropped to 12.71 cents from 13.57 cents the year prior. Management pointed to the absence of a one-off divestment gain, but a forensic audit tells a more sober story. Even when you strip out those one-off gains from the Tanglin Halt cluster, the organic distribution per unit still declined by 3.2% year-on-year. This 6.3% headline drop is a clear failure of our growth threshold. It signals that the internal engine is struggling to keep pace with rising costs. To understand why this drop happened, we look through 5 forensic lenses. First, the raw fact: your 12.71 cent distribution is now fully funded by organic rental income. That is actually a cleaner starting point. Second, last year's figure was artificially boosted by non-organic gains. That context matters. Third, peer comparison. While Capital and Ascendas REIT managed a smaller drop, they did so by diluting unit holders with a massive equity raise. Mapletree Industrial Trust chose the accounting pain of a distribution drop over the permanent damage of dilution. Fourth, a $600 million interest rate hedge wall is looming in financial year 26-27. That is another drag on your income coming down the track. And fifth, the wallet impact is real. For a 50-year-old holding 50,000 Singapore dollars of this REIT, your annual income just dropped by over $200. That is like losing 5 cups of coffee every single month. The footnote that actually matters in this report is the gearing. Management highlighted an interim leverage of 34%. The forensic surgery reveals that this figure is expected to climb to 37.5% once the debt is drawn to redeem perpetual securities. 37.5% breaches our 35% fortress standard. It is a significant shift in the risk profile of the trust, moving it away from the ultra-conservative territory we prefer for retirement capital. When you see a breach of the fortress standard, you have to ask, what happens if valuations take a hit? The silence from management on portfolio occupancy is the loudest signal we have. North American data centers are at 86.1%. Backfilling a lease in Tempe, Arizona is genuine progress. But the confirmed non-renewals for the coming years are already locked in at 4.7% of total gross rental income. This is not a theoretical bear case. It is a signed decision sitting in a filing. The high-performing Singapore assets, 93.4% occupancy, positive 6.2% rental reversions, are effectively subsidizing the leaks in the American portfolio. We also need a reality check on the premium you are paying versus the eroding book value. With the unit price at $1.98 and the net asset value per unit at $1.63, Mapletree Industrial Trust is trading at a 21.47% premium to book. The market is pricing this as a Tier 1 digital infrastructure asset because over 57% of the portfolio is now weighted toward data centers. But you are paying a 21% premium for an asset whose book value fell by 4.7% this year. If the planned $500 to $600 million in North American divestments fail to execute, that premium could evaporate very quickly. To find the true risk premium, we calculate the yield spread against the live risk-free rate. The current asset yield stands at 6.33%. The 6-month T-bill auction in April 2026 cleared at 1.4%. That gives a spread of 493 basis points, which looks generous on the surface. But this comparison is flattered by a historically low T-bill rate. In the heartland, we do not just look for what is generous. We look for what is sustainable when the market turns volatile. When we apply the forensic floor test, the picture becomes tighter. My conservative floor is 3.2%. I audit for the storm, not just the sunny day. Against this forensic floor, the spread is 313 basis points. That is still above our 150 basis point minimum hurdle. But the floor is doing a lot of the heavy lifting here. Mapletree Industrial Trust clears the bar for yield. Clearing a bar is not the same as having a comfortable distance above it. The yield is functional, but the safety buffer is thinner than we would like. The income sustainability scorecard gives us a mixed bag. Distribution per unit growth failed the benchmark significantly compared to peers like CapitaLand Ascendas REIT. The net property income margin of 74.34% passed the benchmark. Singapore rental reversions of positive 6.2% show that the internal growth engine is still functioning. The 6.33% asset yield clears our minimum hurdle of 4.7%. The trust is still generating enough cash to satisfy the basic requirements of an income investor. The debt health table, however, triggers a gearing alert. The pro-forma gearing of 37.5% is a clear failure against our 35% threshold. Net debt has actually decreased, which is a positive. But the interest coverage ratio is sitting at exactly 4.0 times. That is not a failure yet. It is the absolute borderline of what we consider acceptable. It means there is zero margin for error in the coming quarters. Any significant spike in interest costs or a drop in income pushes this metric into the danger zone. These cracks in the balance sheet are visible to anyone willing to look. The pro forma gearing breach after the perpetual securities redemption is the primary concern. An interest coverage ratio at exactly 4.0 times means the trust is walking a tightrope. And compounding this is the $600 million swap wall looming in the first half of 2027. That interest rate hedge expiry is a structural threat to any potential distribution expansion in the near future. It creates a ceiling on how much growth you can actually expect. Three scenarios help us stress test the future. In the bear case, where North American non-renewals compound and hedges are replaced at much higher rates, we could see a distribution per unit drop of another 2 to 3%. The base case assumes occupancy stabilizes and the divestment program stays on track, flat distribution per unit. In the bull case, a successful hyperscale pivot and accretive Asia-Pacific acquisitions could return the distribution per unit toward 13.5 cents. These scenarios help you decide whether the current yield is enough compensation for the risk of the bear case materializing. Management's credibility score is currently split. They earn points by refusing to dilute unit holders and by executing the Singapore portfolio divestment at an 18.6% premium to valuation. That shows genuine asset management skill. But they lost credibility by allowing the North American enterprise shell strategy to falter so visibly, occupancy slipping to 86%. The open question remains, can they execute an additional $500 million in North American disposals while simultaneously backfilling that vacant space? The real tension here is the gap between the confident tone on the earnings call and the 4.0 times interest coverage ratio sitting exactly at our threshold. Singapore is holding the line with grit and strong rental reversions. But the American leaks must be plugged before the $600 million swap wall hits in early 2027. There is simply no room for execution errors in the next 12 to 18 months. The Singapore franchise is the anchor, the American portfolio is the unresolved question. In this market, the difference between a sanctuary and a yield trap is often decided in a single trading session. While free subscribers are reading yesterday's story, Iggy's elite investors are already cross-checking the next setup together in real time. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you get 0-day breakdowns and the full institutional-grade cheat sheet the moment it is finalized. If you want the edge before the market opens, the link is in the description. Our forensic stance on Mapletree Industrial Trust is currently set to watchlist. The 6.33% yield is your compensation for bearing this uncertainty. It is not a free lunch. The confirmed non-renewal of 4.7% of gross rental income in financial year 26-27 is a scheduled event, not a theory. While the Singapore franchise remains strong, the North American portfolio remains the big unresolved question for this audit. We are watching the gearing and the interest coverage ratio very closely. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.